Live from the Business RadioX studio inside Renasant Bank, the bank that specializes in understanding you. It's time for North Fulton Business Radio.
And hello again, everyone. Welcome to another edition of North Fulton Business Radio. I'm John Ray, and folks, we are broadcasting from inside Renasant Bank in beautiful Alpharetta. And if you're looking for a bank that you're not going to have to worry about picking up the paper on Monday morning and reading about them in the headlines, you know what I mean by that if you've been following the financial news this year, Renasant Bank is your bank. And here's the bonus. They're big enough to handle pretty much any need you can throw at them as a business, but they're small enough to do it in a personal way. I know this myself from my dealings with them. So go to RenasantBank.com and find one of their local offices and be in touch. And guess what? A real person will answer the phone. Imagine that. Renasant Bank, understanding you, member FDIC. And here's a guest I've been looking forward to for some time. Jan Saperstein is with us, folks. Jan is with Southeastern Asset Management Group. Jan, welcome to the show.
Good. Thanks for having me.
Yeah, thanks for coming on. So let's give everyone a brief introduction to you and your work at Southeastern Asset Management Group. How are you serving folks out there?
Well, it's a good question. First, I'm going to say to you that the way you introduced the bank seems like somebody I need to get in touch with ourselves. It does. Southeastern Asset Management Group acts as a asset manager, which basically oversees multiple investments in commercial real estate, primarily shopping centers. It's not the property manager. It basically acts as the owner's representative and interfaces and sort of guides the ship, so to speak. Right. So it doesn't take roof leak calls, but we oversee the budget for roof leak vendors simplistically. So that's how we work.
Got it. And you've got an interesting history when it comes to how you got into real estate. You and I were talking about this on a pre-show call. Share that story if you would.
I'd be happy to. Got out of the University of Georgia and didn't have a clue what to do. This is in the early 80s. And my mother at the time was the executive secretary for, it was first, I think way back when, it might have been First National Bank of Atlanta. Back in the day, which evolved to, I think, first Wachovia and then Wachovia. Anyway, it's evolution. But at the time, she was executive secretary to the chairman of the board, and one of the conversations, not directly to me, but one of her general conversations, was about how I think 6 or 7 of the largest depositors in the bank were all of these people who own commercial real estate. And it wasn't like, do this. It wasn't directional.
Sure.
It was just a conversation. Epiphany, that was it. I said, I think I can figure this out. Right. And that's what started my journey.
Wow.
That was it.
Yeah.
So
that's a great story. She may not have meant that to be a causal connection, but you took it that way, right?
I took it that way. I think there's a higher order. I don't know what that means, but that's pretty much what happened.
Yeah.
And the key was always, and it still is the driver, is that the reason being is that they're making more of everything. They're making more of me and you and these computers and our car phones and everything but land. They're not making more of it.
Yeah.
So that simple premise is, investing in the most limited commodities is what drove me to understand commercial real estate. Residential, I had no interest in it, but commercial made sense to me. So that was it.
Well, you teed me up for my next question, which was going to be why not just commercial, but specifically retail, shopping center, real estate. What piqued your interest there, pulled you into that sector?
Well, I'll tell you simplistically, again, they're not making many, hypothetically, Peachtree and Piedmonts, right?
Mhm.
In the office world, you want to be a tenant, hypothetically, wants to be in a certain macro market. They want to be in Johns Creek. They want to be in, Buckhead. And
Mhm.
so the area is dominant as opposed to the intersection. And it's hard to duplicate major intersections.
Mhm.
So therefore, because of, traffic patterns and coming and goings, that's what you sort of want. It's easier to identify. It's easier to identify Peachtree and Piedmont therefore you can deal from strength with tenants and with lenders, because hypothetically, if you own this major intersection, as opposed to owning, somewhere in hypothetically Buckhead or Perimeter, where, the area, you can have an office building in that periphery.
Mhm.
So, it's just a little easier to understand, at least for me, the gravitational pull toward just major intersections.
Mhm.
It was easy to understand.
Yeah.
So,
Yeah, that makes a ton of sense, particularly when you're talking about limited supply, because as you say, there's only so much around
right,
those four corners of,
right,
to your example, Peachtree and Piedmont.
correct, right. So that's the reason why it's sort of a simplistic, in my thinking, it's that where's the most limited commodity, and how can I own it,
Mm-hmm.
or get close to it, and that's always been the driver, right? Because
Yeah, absolutely. So part of what we were
mhm,
talking about leading up to the show is
mhm,
how you pretty carefully, and I was very impressed by this in our conversation, you carefully understand what's going on with your tenants in terms of their economics and
right,
what is important for them, and therefore, because they're obviously their rental payments every month come out of
right,
revenue, and so it's important for you to understand how that works.
right, exactly. And a lot of it is simply, in our world, since this is our real estate and we own it, right?
Mm-hmm.
Where last thing I want is for a tenant we put a tenant in, having the rent be the driver and not the use,
Mm.
because uh, there's no reason to have a tenant in there that can't pay the rent, and you're going to end up with a vacancy. It's going to start all over again, right?
Right.
So knowing somewhat certain categories of tenants and what they can pay, right, can dictate the type of tenant that you want to be able to put into a certain box within your shopping center, and how their rent equates to uh, uh, how their annual revenue equates to what they can pay you in rent. Meaning, if you have a tenant that's paying you does $1 million a year in sales volume, general rule of thumb is 10% rent to sales. So which means that tenant can pay $100,000 a year,
Mm-hmm.
right? So simplistically, that's what we think that tenant can cover in rent. And so some of the restaurants, some of the retailers like grocers, okay, their rent to sales ratio is probably closer to 3% or 4%, right? But
Mm-hmm.
then you have some mom and pop restaurants who, end up paying 20% rent to sales. So that's why, to some degree, and one of the factors is there's a lot of turnover in that business. But so that's what I sort of look at, and knowing that, hypothetically, if a sandwich shop that can do, does me $500,000 a year, says, look, we love this location, and we'll pay whatever the rent happens to be, and their rent to sales ratio is 25%. I'd rather not have them as a tenant, because it's just going to be a matter of time before I have to re-tenant the space.
Mm-hmm.
So that's sort of the the precursor of the right type of tenant selection. That was a long answer for a simplistic question.
No, that was a great answer. And one of the things that I mean, you again, when you and I were talking earlier, you were talking in some detail about the demographics, the psychographics of your tenants, and that you get into that kind of detail as well.
I do, because and 1,000 years ago in a land far away, I actually gave a couple of presentations to some commercial real estate groups about the average shopper and the type of shopper. And at the time, this is a little bit pre e-commerce to some degree, but the perfect shopper is about 75% to 80% of all retail trade is women. Okay, and that's who makes the buy. That's who makes the buy decision. And so that's the type of tenant that we want to have in our centers that attract that customer, because that customer is, is what drives that specific user. And so we want to get as many female-friendly operators, tenants, as we can have. And it's evidenced not just simply by me, but by a lot of other retailers. You'll see, Lowe's has lowered its shelf height so women can see over. Target's a perfect example where they've spaced out and lowered the shelving height. So because they're doing that, not for me and you, they're doing that for women. And so in today's world, that could be too sexist, but that's just how that's how simplistically it works, right? And I'll give you a question.
Yeah.
Okay. We might have had this conversation, and if we did it before, then you can say you did. It's like, what's the first thing you see when you walk into a grocery store? Did you and I have that conversation?
We did, and thankfully I know the answer. That's the only reason I know the answer.
And what is the answer?
It's flowers.
Right.
And,
why?
Yeah.
Why?
And just to be honest, listeners, before Jan and I had that conversation, I had no idea what the right answer was, even though I passed them in grocery stores every day. Yeah. So, and it's flowers because it appeals to women shoppers, makes the space look beautiful. All the reasons why. Yeah, you would have that right up front, as opposed to batteries or dog food or something.
Right, exactly. And you see that. It's funny, as I see it at the Walgreens near me. Traders has it, Kroger's has it, anywhere that wants to attract that shopper. And being sophisticated businesses and retailers, that's a lot of times that's a driver.
Yeah,
the huge driver. Yeah, right. So that type of sophisticated retailers who we like to have in our center.
Yeah.
Right.
So and so you're what that really boils down to is it's a retailer that understands their business, and therefore you're going to be able to count on consistent cash flow from that retailer because they understand their business and because they know how to attract customers and generate revenue. I mean, it's that simple, right?
It is that simple, but we also don't want them to get into an over leveraged situation where they can't afford the rent. Their ratios are skewed. And so it's as I always say, it's dull, boring cash flow. We want dull, boring cash flow. And so that's the goal, so. Yeah.
Folks, Jan Saperstein is with us. He is with Southeastern Asset Management Group, who all they do is generate dull, boring cash flow. So,
well, that's the theory. That's the theory. There's always ebbs and flows to that.
Yeah. So, well, let's talk about the development of the business over time, Jan. So, talk a little bit about the history of your business.
Well, I went to work after that epiphany through my mother. I went to work. I got a real estate license. I went to work for a local developer who has since passed on. past Charlie Ackerman. He had a large commercial real estate firm here, and worked for Charlie for probably maybe 4 to 5 years. And at the time, we had also procured the Chick-fil-A account. And so I left Charlie and started doing Chick-fil-A's real estate with my own firm, my own company. And that taught me, direction. It taught me traffic patterns. It taught me who they want as demographically that surrounds them. And that same knowledge is applied to different types of tenants. Why does one tenant want to be in a certain area? Why does one tenant want to be in another area? So the evolution of understanding the tenant and understanding the market that they want to be in allowed me to understand what to buy. Right? Just wasn't buying something because, here's a shopping center that looks physically attractive. It's this simply knowing that submarket has this type of demographic. So if that tenant goes out of business, there's some other tenants that will step in and backfill it because of that specific type of demographic. So it gets the properties in the batter's box repeatedly over time, right? So, that's sort of what we try to choose.
Yeah,
right.
Yeah. So, talk about developing your own properties versus buying existing properties, and kind of the decision set that you go through there.
Well, it's funny because at the time, the last property we developed was numbers of years ago, simply because by the time I can look at a shopping center that's for sale and in theory own it in 60 or 90 days. Okay. When you're developing, it's a long haul. You're subject to interest rate spikes. You're subject to, construction cost overruns. You have to go through zoning. Long story short is it's a real job, right? And after a little while, I sort of tapped out of that. I said it's easier for me to understand. I can go buy something without having to go through all the brutality of having to deal with the local governments and plans and financing. So to me, it was just a path of least resistance. That take advantage of somebody who already went through that, and and there's no question that my partner always says he and I would definitely screw it up. So we're being a developer and investors. Sometimes they're not mutually attractive.
Yeah.
So
yeah. Well, and I guess what you're talking, excuse me, what you're talking about is really uncertainty. That right versus what you can control. I mean, that's really sounds like the trade-off what you're talking about there.
Yeah, you're until you receive that certificate of occupancy that might have taken you 2 years to get to that point. It has to be a perfect convergence as well of is the marketplace still stable for that type of development, right? And because there's always constant ebbs and flows in commercial real estate to some degree, right? You have to have the horsepower to be able to let that river run. But in my world, after a little while, I said, I don't. It's just too much risk reward. Risk is not. I have no problem with risk. 100%. Let's do it. But it's educated risk. So we'll either buy a property and just ground lease it, okay, and let the tenant go build and do whatever they want to do and just pay us base rent. But actually going and building a box and having to go through that whole design process is I've sort of honestly backed away from.
Yeah.
So that would just make them.
Yeah, that makes a lot of sense. So you your investments, are they exclusively here in the Atlanta area?
Well, primarily at one time we had other properties out of state, but There's also a good time, it's you have to know when to basically, what's that song? Know when to hold them, know when to fold them. I mean, meaning that sometimes it's time to sell. So the point is, these properties that had gotten out of state, and we were depending on out of state third party management, out of state third party leasing, right? For our small company, it was too onerous, so we decided to sell. But right now, we're primarily all over Atlanta, and we have a beautiful shopping center and outside of Savannah in Hinesville, Georgia. That's a power center down there with I think Dick's and maybe TJ Maxx and I think Hobby Lobby, things like that.
Right.
Right. So, right.
So I am quite certain that listeners are at this point are wondering, whenever I'm going to ask the question about e-commerce and the effect of e-commerce on physical in-person shopping and how that has all factored in to your investment work.
That's a good question. Since e-commerce came in, two things have happened. I'll use Restoration Hardware as an example. When you go to Restoration Hardware, you're basically walking into a showroom. You can't buy anything off the floor, right? So they've taken that expensive real estate and moved the inventory from it traditionally to a warehouse somewhere. And so that's how I think there was a good ability to sort of navigate through e-commerce for them. That was a nice shift. Also, something that's not e-commerce affected by Amazon or e-commerce as well is specialty service users, meaning chiropractor, dentists, doctors, things that you just can't buy online. FedEx, for example, is a great, UPS, restaurants to some degree, things that are somewhat e-commerce proof have become more attractive. So we love to have dentists, they're service providers. So those are great tenants, and also retailers that have navigated through and understand e-commerce, like discount stores have exploded, dollar stores. Burlington is the poster child for that. So again, they're very sophisticated retailers and understand how to, but that's who we want to have as tenants. These are very sharp business people, billion-dollar companies, and that's who we want as a tenant.
Yeah, that really does take some sophistication as you think about all the implications of this shift from a retail establishment to one that's essentially a showroom for what people see online. I mean, there's a lot of that's easier talked about than done in practice.
Than done. Right. Yeah. And when Restoration Hardware did that years ago, it was a very new and novel approach, and now I understand it. First time I walked in, I said, we like whatever it happened to be. My wife and I walked in. We said, we'll buy that. And they said, well, we can't sell that to you.
Right.
Okay. It's just a showroom. It's a lifestyle look. So that's I think, and because real estate has become very expensive for tenants, their evolution is to use their stores not for inventory, which is an expensive inventory location, more of a showroom. So, I think it's very smart.
Yeah.
Yeah. Right.
Why dollar stores?
People love a bargain. I mean, they just love a bargain. It's funny. I heard this years ago with Walmart. Walmart would go into a town, and the first generation Walmart was replaced by a second generation Walmart. And I mean, Walmart, hypothetically, you think their first box was 50,000 feet, whatever it happened to be. Now they're 250,000 feet. But what it would do it would also decimate the town. Okay, so Walmart would not sublease their old location. Okay, which would block out other competition, and then it would also hurt the town. And so I forgot where I actually read this or saw this, but people were discussing whether it was beneficial to have the Walmart there as opposed to the detriment of the town, of the local towns. And people ended up basically saying unanimously, we'd rather have a deal. We'd rather have cheap prices. Okay. And so because of that, that's the core issue of dollar stores, and so that the outlet mall industry, that's a whole nother chapter and verse, but a lot of these started because they had excess inventory, and so that was a way to not be taxed on it. And they opened, dollar locations. It's cheaper to sell stuff for $1 than pay tax on the excess inventory.
Yeah.
Outlet malls that's their core. That's what they started. They had all this excess clothing and they were being taxed on it. So they said, well, let's just go sell it. Right. At these outlet malls, and they stayed far enough away from their other clients. And that's what got the outlet mall industry going.
Jen, how? That's fascinating. Jen, how important are the demographics of a particular area to you versus just the fact that they're major intersections? Because those aren't exactly the same thing always and everywhere.
Correct. Absolutely. Right. Demographics to me reflect back on the type of tenant. You want the ability to fix a problem, and meaning that, again, what I said earlier is you have a shopping center, a certain area that has a certain demographic, which attracts a certain type of tenant, right? Years ago, we had an Office Depot in one of our centers, and I was asking the Office Depot real estate rep, basically why you're here. They said, we want to be in the area. Their commercial business wasn't the goal. The goal was to be near the families. So a family could go in there, and because they needed school supplies, right? And they needed printers and all the other issues. So that demographic where they put themselves, might have been, business light, right? Neighborhood businesses, but the demographic of the area provided their customer. So everybody's different, right? I mean, Goodwill is a prime example. Goodwill wants to be in areas that are very high end. You wouldn't think that it would be, but they are, because they get high end donations, right? And so people, we had a property in Buckhead that Goodwill at one time wanted, and the neighborhood said, we don't want Goodwill Industries, but they want to be there because they knew they would get really high end donations. And so it's all about the demographic, and then it's all about access to the demographic and who your customer is. Yeah. So.
Gotcha. So what's the future look like here? I mean, what are the secular changes, either good or bad, that you're seeing that are going to affect investment in shopping centers?
Well, that's a good question. Again, I think that, service-based tenancy is now the core. Grocers are the core. Drugstores are the core. So I think people still need to eat. They still need to get dressed. They still need drugs, right? And they still need the services, the dentists and the physicians and things like that. So I think that's going to continue to be what's the backbone of, and what you want to invest in when you're looking to invest in real estate. It's just the surety of the surety of the cash flow. Meaning that I heard I was talking, I think it was Bank of America guy one time. The lowest default rate were I think pediatric dentists, maybe, or dentists in general. So that's who you want as a tenant, right? So to answer your question, the future of real estate, from my perspective, it's sort of still down the middle of the fairway. Urban's wonderful, but I sort of shy away from a lot of the mom and pops being the lead generator, right? So we're more of a, we want to be more traditional. It's family. We own it. We started it, and so we want to keep it in the family. So, would you rather invest in having CBS as your tenant, or Bob's Drugs, or John's Drugs?
Yeah.
So
certainly CBS versus John's Drugs.
Yeah, John's Drugs, right? So that's it. So I hope I answered your question. But
yeah.
Yeah.
No, that makes a lot of sense. And you mentioned urban. I was going to go toward, suburban, ex-urban, whatever that means, beyond suburban Atlanta,
right.
And then urban. I mean, how do you even look at it that way?
Well, it's funny because Atlanta is a great center, great draw, great real estate investment. For real estate investment, our vacancy rate, at least for retail, is very low, right? And traditionally, you would have shopping centers that would sort of, if the regional malls were the mothership, you'd rather hang around the regional malls. But since the regional malls have sort of, some degree, the big anchors, have sort of taken on the chin. So now it's because of the traffic in Atlanta specifically, these outlying areas, which used to be more of a, let's go up to Dahlonega for the day. Now in theory, Dahlonega is now a suburb, right? Right.
Yeah.
I mean, so do you want to, let's be smart and leapfrog. Let's go up and look around Dahlonega. Let's go look around North Georgia. Let's go look around, Clayton. Let's go look around those areas like that, because the exodus is coming. The traffic in Atlanta is a major city, and so it reverberates out. So once again, shopping's convenience, and your customer, being who we think they might be, doesn't want to deal with the traffic. So suburban versus urban, that's, I understand it. It's conflict avoidance, and people don't want the stress to having to go park in a multi-tiered deck to go buy groceries. I get it. So they'd rather, go and up to Forsyth County, up to near Avalon is great.
Yeah. So,
but interestingly enough, and this isn't something you asked, but there are applications that our agents use that basically tracks foot traffic into certain malls and certain tenants. For example, we have Trader Joe's as a tenant. Trader Joe's will not tell you their sales. They're private. They won't tell you their sales. Okay. But there's certain applications that will tell you the footsteps, the number of footsteps into that store, and they track it by your cell phone. So you could say, for example, which malls have the highest foot traffic? You don't know what the sales are, but in theory, you have foot traffic, which is sales, right? Eventually turns into sales. So that will tell you which markets are having the largest visitations. And I mentioned Avalon earlier. I think Avalon up in Alpharetta coming is one of the most populated centers, visited centers in the metro area, based on basically just foot traffic. So foot traffic translates into views, and views translates into customers. So yeah, I'm sort of giving you a windy answer, but
I like it. Well, there's a lot there to mull on. And one more thing while we're talking about suburbs, you mentioned some of the redevelopment, and malls don't seem to be something you pay a lot of attention to from an investment point of view, but I guess you're an observer of what's going on there. So how do you view some of the redevelopment of malls that some of the suburbs are, like Alpharetta's looking at North Point Mall. I know, Gwinnett's looking at Gwinnett Mall. What does that look like from your perspective, and what's going to be successful?
It's a good question. It's hard because those are dinosaurs. I mean, Gwinnett Place Mall just got eviscerated by Mall of Georgia, where we happen to have a center as well. So it's an adaptive reuse. Okay, is it? I think Gwinnett Place Mall might have been purchased by Gwinnett County.
Right.
And so the issue is, what's the adaptive reuse? Is it apartments which have been taking a lot of spaces, right? Or some type of a backfill superstore, ethnic superstore happens to take a few of them, but a lot of them is simply the land, going back to the land. So the area might be solid, but the mall itself is dysfunctional. So the issue is, how can you adaptively reuse those buildings? I saw summer recently, and my wife and I just started playing pickleball, although I don't know if maybe 3 or 4 occasions playing pickleball is called actually participating in pickleball. But I have heard that some of these older stores are now turning themselves into pickleball courts.
I've heard that, yeah.
Which to me, there's a perfect example of adaptive reuse. Right? Now, do you want to invest in a store that has pickleball as your tenant? Is another chapter. Right. I don't, but maybe you do. But I think that's a really nice adaptive reuse. Those malls, those enclosed malls, are a real dinosaur. They are, and smarter guys than me are struggling to continuously to figure them out. Right.
Yeah. Jan Saperstein, folks, Southeastern Asset Management Group. Jan, I could keep going for quite a while, but we need to. This has been fantastic. I've learned a lot. I know our listeners have. If someone would like to be in touch, can they? And if so, how can they do that?
I can give my email address, which is probably the easiest thing to do, right? I'll spell it for you. It's the initial J, Saperstein. It's SAP, as in pizza, ERSTEIN, at SEAM, short for Southeast Asset Management, SEAM.us.com. And I'm really empathetic with people who want to do this, because I didn't start with any money, and that's a whole nother thing, is how do you get money to go do this, right? And so I think that's novel too. Usually getting 45 years of experience and being able how to do that. Everybody says, "Oh, I love it, but I have no money." It's like, I didn't have any money, So how do you sort of break that code? So
that sounds like a whole nother show. We may have to
have
you back for that. Yeah,
that's true.
We may have to have you back for that, Jan.
I'd be happy to have it.
Yeah, terrific. Jan Saperstein, folks, Southeastern Asset Management Group. Jan, it's been a fun and pleasure and informative. Thank you so much.
Thank you for having me.
Absolutely. Hey, folks, just a quick reminder. Thank you again for your support. We just passed the 7th year anniversary of this show. We've passed, I think, 660 episodes, something like that, of this show. And we've only done that because of your support. So thank you for continuing to do what you've done in the past. Share the show when you've heard a great business leader like Jan that you think others need to hear from. You've shared the show, and you've followed us on social media and given us all sorts of praise there and big thumbs ups. And we appreciate that, because that helps people find the show, and it helps us fulfill our mission to be the voice of business in the North Fulton area. So for my guest, Jan Saperstein, I'm John Ray. Join us next time here on North Fulton Business Radio.